I'm Kate Moody, Strategy Director here at LMFS, and you're listening to FinTech Insider News. Your top stories this week. Visa and MasterCard have reached a $30 billion settlement over transaction fees for merchants. They've agreed to reduce their card processing fees and commit to a cap for the next 5 years, as well as scrapping their unpopular anti-steering rules. Wealth building platform Belong launches its waitlist. The new app aimed at professionally employed millennials offers a boom loan to give users a quicker start on their investments. And the FCA are clamping down on social media influencers with a raft of new guidelines to help banks promote themselves more responsibly online. We discuss all of this and much more on today's show, so don't go anywhere. Hello and welcome to episode 840 of FinTech Insider. I'm Kate Moody, Strategy Director at 11FS, and I'm joined on this week's FinTech Insider News by three fantastic guests who are going to break down the biggest stories from the past week in FinTech and financial services. Firstly, I'm delighted to welcome my co-host, Rachel Pandian, Ventures Product Lead at 11FS. Rachel, obviously, we spend a fair amount of time chatting to each other anyway, but always nice to do it when it's being recorded and distributed to the wider fintech community. So how are you doing? What are you up to at the moment?
Yeah, I mean, apart from spending a lot of time on meetings together, at the moment we're just looking at some new projects coming up, and so planning and doing a lot of thinking around what they look like and some really exciting things in the pipeline. So mostly a lot of that.
A lot of that, absolutely. We're also delighted to welcome back to the show Jason Mikula, founder of FinTech Business Weekly. Jason, always great to have you on the show. How have you been? What's going on in your world at the moment?
Yeah, I've actually been working from Mexico City this month, which has been enjoyable, if not a bit of an adventure. Actually, the last podcast I recorded was from the bathroom because they were doing construction outside. So let's consider ourselves lucky that it is significantly quieter today.
Fingers crossed. And finally, another big FinTech Insider hello to Doug McKenzie, journalist and presenter, formerly head of content at FF News. Doug, also a pleasure to have you back on the show. Which country are you based in at the moment? What's going on?
Where are you guys? I'm here at the at the FinTech Insider Hub. Thank you so much for the intro, and really excited to be on the show again. Been moderating, presenting, and doing a lot of really exciting stuff recently, and a lot more to come out in the coming weeks.
Absolutely. Well, thank you all for joining me. Let's jump into the news. There's some exciting stuff for us to cover. So our first story this week, we've taken it from Reuters, but it's popping up in lots of different places now. Visa and MasterCard reach $30 billion settlement over credit card fees. On Tuesday, the largest antitrust settlement in US history was announced as Visa and MasterCard agreed to limit credit and debit card fees for merchants in a deal thought to be worth $30 billion. If approved by the courts, it would resolve almost all claims in nationwide litigation that began way back in 2005. Merchants have accused Visa and MasterCard of charging inflated swipe fees when customers use their credit and debit cards, while also preventing them from steering their customers to cheaper alternatives. Swipe fees consist of a small fixed charge plus a percentage of the sale amount and could cost anything up to 3.5% per transaction. Reuters reports that under the settlement, Visa and MasterCard would reduce swipe rates by at least 4 basis points for 3 years and ensure an average rate that is 7 basis points below the current average for 5 years. Additionally, they have agreed to cap rates for the next 5 years and remove their anti-steering provisions. This is pretty breaking news, obviously, as we're recording this podcast, so plenty more probably to emerge around this. Jason, I'll come to you first. I suppose for our listeners that have not spent 20 years thinking about interchange fees, card fees, how do we kind of break this down? What does this really mean?
Yeah, so I mean, there are a lot of potential angles, lenses, consequences from this to think about. I think it's worth starting out by specifying, a lot of the sort of mainstream media coverage talks about quote unquote swipe fees, but from what I understand of the settlement, and it just came out recently, it specifically is limiting interchange fees, which is one component of the total cost a merchant pays when a user pays with a credit card or a debit card. So when we start to think about who's going to be impacted by this, the headline is, businesses should realize that, 30 billion or so in savings over a 5-year period. That 30 billion is not coming from Visa and MasterCard, it's coming from the issuing banks, right? So your major card issuers like Chase, Bank of America, Citi, those are the players that are most likely going to see the majority of that revenue hit from this settlement, not Visa and MasterCard. The portion of the total swipe fee or merchant discount rate that goes to the networks, which is sometimes called an assessment, it is not impacted by this settlement. So, I mean, I think that's one piece to remember. Another, knowing that our panel here and your audience is international, is the U.S. is like a very bizarre, extreme outlier when it comes to interchange rates, right? So I'm American, spoiler, live in Europe now, and in the EU, debit is generally capped at 20 basis points or 0.2%. Credit is capped at 30 basis points. So you don't tend to see credit cards with these crazy rewards like you do in the US. So definitely some things to watch there. One last point, this settlement is coming on the heels of a lot of other developments that are likely to impact both the debit and credit card economics and ecosystem. So recently we've seen Reg II, which gives issuers which requires issuers, I should say, to enable two unaffiliated networks when it comes to routing transactions, debit transactions online. We've seen the CFPB propose a $8 cap on credit card late fees, which is being challenged at the courts. The Capital One Discover proposed deal, which can have very significant impacts. The Credit Card Competition Act, which is unlikely to pass, but if it does, would have significant impacts. And the Federal Reserve lowering the debit interchange cap, which has not been changed since it first went into effect. So there's a lot of moving pieces right now, and this is just one piece of a much larger, crazier puzzle.
Yeah, it's a good time to be a payments nerd, I'm guessing. Doug, I don't know if you'd put yourself into that category, but this has taken a long time to get to, right? Like, why do you think it's taken 20 years for us to get a resolution to this?
I mean, when you think of the size and the scale of the US payments market and the fact that they're looking at 50 different regulators within that realistically, and then the fact that I think, and I think my timeline's all right with this, it's the fact that both Visa and MasterCard were still part of banks when this was first mooted back, approximately 30 years ago. So they've gone through these huge wealth of changes of becoming their own organizations and everything that comes with that. And I think really it's one of those things where they've been, moderating what's been happening in the world with the changes in payments, because I think it's all fair to say, as a payments geek, the world has effectively changed from that time dramatically, maybe less so in the United States, but when it comes to payments. But now we're seeing that really have to come to a point where there are so many other providers, and I think it's reached its natural culmination. And of course, whenever you involve litigation of that size, it's always going to take time, isn't it?
Yeah, absolutely. I suppose to your point around like how the world has changed. I mean, I suppose when I was doing my research around this story, I was intrigued. Kind of one of the first search results that came up was an article from the Daily Mail in the UK, which is a tabloid newspaper. And I suppose, like when a sort of a tabloid newspaper in the UK is getting excited about something in payments, it's kind of a big deal. So, but they were actually, they'd interviewed, I think, a US business owner who was talking about, operating for 30 odd years. And they were just sort of saying, as part of this interview, the proportion of payments that were made by cards for their business when he started versus now, like this is just a completely different landscape for merchants as well. So I think that's really important to bear in mind, like in terms of the impact this has had on merchants, like these ever increasing merchant fee burden is really coming to a point where it's not sustainable, I think, for merchants.
I even read that for some it was actually higher than their rent on some of their properties. Apologies, Jason.
No worries. I mean, your point, Kate, I think is entirely correct. Like the percentage of payments, in person and certainly online that are done via card now has increased substantially since when this litigation began in 2005. I will point out that when merchants talk about this, there tends to be an implication that somehow accepting cash has zero cost. And that's just not true, right? There's a very real cost to having cash in the till in the register, balancing that, taking a bag of cash to the bank at the end of the day, or having a armored car or whatever come and pick it up. And so, yeah, on the one hand, yes, there is a real cost to accepting card payments. On the other hand, the analysis also needs to take into account what is the overhead cost of accepting cash payments. And then you get into a whole nother tier of argument of like, well, should merchants be forced to accept cash even when they don't want to? Which is a hot button issue in the US, in places like New York, where maybe people are unbanked, underbanked, unhoused, what have you. In the Netherlands, it's very common to see stores that have a sign on the outside that say, "We only take cards, no cash accepted." So it's definitely an evolving landscape with pros and cons and different stakeholders, the networks, the issuing banks, the merchants, and we haven't even gotten to the impact on consumers, which frankly I think is going to be pretty negative in the US.
Yeah, I think it's definitely something that I thought about when I was reading this, because I think a lot of small merchants are like, oh, well, like now we don't have to pay these fees. This is great. But actually, I was reading some balanced sides on this. There's an article in Business Insider where some people are actually believing that credit card users, especially premium credit card users, are about to take on a larger proportion of the cost in the years to come. And so actually there's a really interesting point around how card holders are already subsidizing some of these swipe and interchange fees. And so this move to reduce fees will benefit consumers who are being charged these fees at the checkout. But also it's a question of which of these merchants are going to pass on these savings, or actually which of these merchants are going to use this to help pad out other very important business costs that they face as small businesses or even large businesses, as the case may be.
Well, in history would suggest that the savings do not get passed along to consumers. I mean, and specifically in the settlement, there is no requirement to pass along these savings. If you look at when the Durbin Amendment to Dodd-Frank went into effect, the savings did not get passed along to consumers. There's academic studies from other jurisdictions which suggest the same thing. The savings, to the extent they exist, tend to go to the merchants. There could be an argument to be made that perhaps it's disinflationary, meaning merchants raise their prices more slowly because there's some savings here. But it's not like you're going to go into, maybe Costco or Walmart that truly compete on price might, but you're not going to go into like the corner bodega or the corner, what do you guys call it, off license, and be like, oh, like my pack of crisps is like 5 cents cheaper because this went into effect. Like that's just not how it works. You also raise an interesting point about cross subsidies. So in the US market, you have these very weird effects where if I'm paying with a premium card, so Chase Sapphire, which is a Visa Infinite tier, that has a significantly higher expense to the merchant accepting it. But as the consumer, I get these like really rich rewards. And so when you look at sort of who's winning and losing at a net economic level, historically it tends to be lower income consumers who are using lower tier cards that have a smaller swipe fee that lose, and upper income consumers who tend to be transactors, don't carry a balance, that their cards carry this high swipe fee, and they get the benefit of that coming back as miles, cashback, points, what have you. And so it's a very very complex, convoluted ecosystem with everyone sort of duking it out.
Yeah, I suppose we've talked about Visa and MasterCard, we've talked about a little bit about consumers, I agree, probably maybe not quite enough about consumers, and we've talked about the banks. Doug, I suppose I'd like to get your perspective on fintechs. Like, how do we think this will impact fintechs? That obviously are issuing, in many instances, cards through these providers.
Yeah, it's going to have a huge change. If you look at the large fintechs and the large tech providers at the beginning, the kind of digital wallets are going to have to completely change their narrative, because now they're not going to just be automatically accepted. So specific wallets are going to be kind of, going to have to be moderated. And that kind of also then goes back to the consumer, where suddenly my Google Wallet is no longer accepted in certain places. And I'm thinking, oh, bloody hell, I should have just gone with the other one. And with that, I think there's going to be profitability overall, but there's going to have to be strategies to overcome that. And it's going to see this kind of maybe an element of innovation around this. But to Jason's point as well, I think it's really going to be the large scale organizations that are going to come out on top with this. And I think that applies to the fintech scene as well, where the larger organizations can, just work with this change, work with the providers, but the smaller ones are having to then go through a huge amount of change. You think of the POS terminals, maybe some of the smaller organizations that work around that, they're going to have to completely update their software and make sure that it goes to rigorous standards. And then that has a knock-on effect on smaller merchants who already aren't very handy with using their POS terminals. And now suddenly they're having to update their entire software system. And I think that knock-on effect is going to be quite interesting.
One last quick bit on the consumer impact. Like, from what I understand of this settlement, it's really quite consumer unfriendly in the sense that merchants, historically there's been this honor all cards policy. So if you take one Visa credit card, you have to take all Visa credit cards, and you can't surcharge or discount based on the issuer. Now this settlement says, hey, if I go into a store, a merchant can say, no, I will not take your Chase Sapphire card, or I'll take it, but I'm going to charge you an extra dollar or an extra 1%. So for a typical consumer, now it's like, well, okay, I have 4 cards in my wallet. How do I know, based on what I'm getting as a reward versus what this merchant wants to surcharge me, which one should I use? And so, on the one hand, the honor all cards and the surcharge rules have bound merchants in a way that you could argue, constrains their ability to control what they're accepting and control their costs. On the flip side, like, this could create a really confusing, purchase experience for consumers who are like, oh no, like, you don't take this card, you take this card, but you surcharge, you take this other card, but you discount. Like, what should I pay with? I don't know. Like, it has the potential to create a very bad experience at the point of sale.
Jason, I've been to the Netherlands when it was only Maestro, and even in Albert Heijn, even in Albert Heijn, coming in with my MasterCard or Visa and not understanding, being that kind of fintech obstinate, that I was like, come on, you must be kidding. Now that we're just applying this in a bigger field, it's going to be interesting.
Yeah, we already see in markets like the US, like Singapore, where customers are much more likely to have multiple credit cards. So even before changes like this, customers were already struggling, precisely your point, Jason, to kind of work out what to use where and how often, and like ultimately, like, what is the benefit to me? So yeah, I think absolutely from a customer perspective, I think that's something that I really want to watch, kind of the consequences fall out for this for. I feel like we could probably talk about this for the entire show, but we're going to have to move on to our next story now, because we've got a ton of other interesting news that we want to run through as well. So this story comes from Bloomberg, and that is Oak North Bank boosts profit and kicks off US expansion. Oak North Bank reported a 23% jump in pre-tax profit last year. In 2023, it ramped up its lending, rolled out a new business banking offering, and initiated its expansion into the US. Busy. It has so far lent $200 million to US banks and is actively exploring mergers and acquisition opportunities to increase its footprint in North America. Since its launch in 2015, Oak North has loaned £10.8 billion and recently hired Lord Adair Turner as it considers an IPO. We caught up with Valentina Christensen, Oak North's Director of Growth and Communications, who told us this.
Thanks very much for giving us the opportunity to talk about these results. Some really good numbers, and the team can be very proud. Profits up 23% to about 187 million pre-tax, which I think demonstrates the ability of fintechs to have consistent growth and profitability, because obviously Oak North has been profitable for several years now, and you continue to see that double-digit growth as well. Notably, lending, 1.7 billion of lending last year. And that's at a time when, according to UK Finance, SME lending was down year on year by about 16%. So really great that we've been able to play our part and sort of step up and fill that void that's being left. We've also expanded geographically. So the results announced the fact that we did about $200 million of lending in the US in the latter part of last year. And we've applied for a US representative office and are actively exploring M&A opportunities there. We see a real opportunity to support customers and businesses in the US. And there's certainly been a void left by the collapse of several banks there last year. In the latter part of 2023, we announced plans to expand our offering in the UK from just lending to a more holistic business banking offering. So current accounts, savings accounts, credit cards, FX payments, etc. And this is very much something that we are continuing to build on. We've got a great waiting list of customers. We've got a number of customers that are onboarded and are giving us feedback every day on the products. So we'll continue to build out this product suite in 2024, as well as expanding geographically with the US. So lots to keep an eye out on. But I think the main point to make is that our doors remain very much open. I think what we've proven is that despite Brexit, COVID, the cost of living crisis, the technical recession, we continue to support our customers and be a trusted funding partner through economic cycles.
Yeah, Rachel, what's your take on this one?
Yeah, I mean, we always talk about UK firms making the shift over to the US, so PensionBee and Monzo recently. But I think specifically for OakNorth, the US SME market is just ripe for disruption. It was called out there, the opportunity with the collapse of a few smaller banks. And I think that OakNorth have invested both from a financial perspective in the policies to be able to lend to those small businesses and really focusing in on that, but also from a technology perspective. Like they've done a lot of work with the existing banks in the region to build out their offering. And so I think that, you know, the move into the US is already, it's well on its way compared to some of the other UK fintechs who are recently into the area. And so I think this is one of the success stories where they've really capitalized on a market need, and they're doing well. So it's really cool to see them as both. I see them as like a real fintech. Like you see both aspects of that in their offering very clearly, and excited to see what they've got to come.
Jason, do you think the US banks will be getting a bit nervous at OakNorth increasing its focus on the US?
I mean, the U.S. banks have plenty of things to be nervous about. You know, I do think there's some interesting differences between other UK/European fintechs that have tried their hand at the U.S. Right. So, I mean, you know, N26 tried, failed, left. You know, Revolut said it was applying for a U.S. bank license, but actually it never really did, which was just kind of odd. It has also experienced some fraud issues with its debit program in the U.S. You know, Monzo and Dutch neobank Bank have both attempted to get U.S. OCC licenses, but withdrew their applications. And none of the consumer products have really hit breakout success. Now, I do think there's some important differences, and you know, I'll be honest, I'm not super familiar with OakNorth's footprint in the U.S., but the fact that it's focused on SMEs instead of consumers, and perhaps most importantly, the fact that it, you know, well, N26, Bank and Monzo are all banks as well, but the fact that it is a UK bank and that it's starting off with a lending product as opposed to a current account debit product, launching and doing credit right, it is far more difficult than launching, a debit card or spending account. So I think starting with that, getting, demonstrating traction, the fact that they're profitable in their home market is also extremely important. So I do think that there are some key differences between OakNorth and some of the companies that have tried and perhaps less successful at tapping the US market.
Yeah, absolutely. And I think it's interesting that they've explicitly stated here that they're looking at M&As. Obviously we've seen, as you mentioned, lots of European, British banks, fintechs looking to kind of go through that application process and struggling. So actually, if they're looking to shortcut that by acquiring somebody with a license or kind of moving in that direction, that might be kind of interesting to see how that plays out. Doug, what's your perspective on this one?
I had the opportunity to speak with Rajesh Gupta, the CFO of OakNorth Bank, and it was amazing hearing their perspective of how they were tackling it, because they knew the size of the opportunity. But Valentina then just mentioned how some strategic banks collapsing has given an opportunity in the market, but there's still around 5,000 banks in the US, and I know a lot of them are credit unions and focus specifically on, for instance, good old SVB, Silicon Valley Bank. Obviously, obviously, targeting just the tech side of things, or then you have farmers unions. But I think what they've done is they've kind of created this brilliant offering where it just applies to any SME across the US. So I think it's absolutely fascinating what they've done. And Rajesh brought up just the opportunity and the size, access to capital, the reg environment over there, and the tech ecosystem and access to talent just enable you to springboard it. So I think it's absolutely amazing.
I don't know why. I feel like I have a slightly irrational frustration with OakNorth that is not like founded anything logical at all, but they acquired a company called Fluidly in the UK a while ago, who I was a big fan of. They were doing some really interesting things around sort of cash flow forecasting, and they sort of acquired Fluidly and sort of brought them into OakNorth's offering. And I'm still kind of waiting to try and sort of see from the outside, as sadly I'm not a business that needs to borrow millions of pounds, so I can't kind of go in as a customer and have a look. But I really kind of want to see how they're starting to bring some of these acquisitions into the experience they're offering to their customers. So I suppose I was really excited when they were announcing kind of this move into broader banking services that Valentina touched on. I guess you just sort of hope that they're not spreading themselves too thinly and trying to kind of succeed in the US, delays kind of them coming in and further disrupting the UK market when they obviously have some really interesting tools at their disposal to do that. So, yeah, Rachel, do you have any other irrational things like me, or have you got a much more objective perspective on what OakNorth are doing?
But I think you raise a really interesting point, sort of to what Jason was saying earlier. I was reading a great article in The Banker around how it's about niche lending. That's what secures profitability. So another UK fintech who did this very well is Alika. And so I almost wonder, by diversifying their offering to, I think you almost need to pick one or the other. Lending is obviously a very profitable business model. A lot of banks, when they're starting out, try and aim to deliver those services. But as you start to explore other adjacent services, banking, treasury, all of those different functions that businesses need, that requires a lot of time, and you start to move away from being a specialist lender and moving more into core banking. And I don't know how you do those two things well. The reason why they've done so well so far is because it's that SME lending and really getting to the pain point. And so I do wonder, for all these acquisitions that they're making around wider banking services, does that dilute their offering? What does it mean for their business? Are they still going to see these numbers in a few years' time if they're starting to expand their services? And so I think, when we talk to SMEs like Kate, you can obviously speak to it a lot. You've seen a lot of the jobs to be done come out of it. It's cash flow is a really big issue, trying to get the services like access to capital, trying to get all your documents in order, lots of disparate services. Is this just another, by launching all these additional services, is it just another distraction for small businesses when they're like, just give me the capital that I need to run my business? I don't almost the other stuff is secondary. It's a lot of noise right now. So yeah, I think I always do have that irrational fear when there's big ambitious growth strategies. But I mean, if you're profitable, if you've got the room to experiment, that's sort of exactly what you should be doing, I suppose.
Yeah, absolutely. And yeah, they've been kind of one of the leading success stories in both UK fintech, but also global fintech in terms of getting to profitability. So absolutely, just keeping everything crossed that this move is a success for them. They continue to kind of go from strength to strength. So one to watch, as Valentina says. We're just going to take a very quick pause here. We'll be back shortly. Welcome back. Before we get into the second half of the news today, a note to go check out our most recent FinTech Insider Insights show. In this episode, Benjamin Ensor is joined by Lord Holmes of Richmond, Pat Patel of Elevandi, and Miranda Perumal from Scale to discuss FinTech hubs. They chat about how to create a FinTech hub, the benefits they bring, and the importance of maintaining a strong relationship between government and industry to drive their long-term success. So go check that out in our podcast feed. It's the one just below this. Okay, let's get back into the news. This story we've taken from FF News, and that is wealth building platform Belong launches out of stealth following the largest ever European pre-seed round by a female founding team. The waiting list for a new wealth building platform Belong is now live following £2.95 million in pre-seed funding. This makes it the largest pre-seed funding round ever by female founders in Europe. Belong, aimed at professionally employed millennials, is the first platform to offer customers an optional loan to scale up a long-term investment in equities. It also offers a boost loan feature, allowing customers to add more upfront and pay back over time, thereby increasing the compound value of their pot. The company claims these tools have been previously restricted to the wealthier minority, but with only a £1,000 minimum investment, they hope many more millennials can now access Belong's products. In beta testing to date, they found 84% of customers have opted for a boost loan, with 100% retention and on-time repayments after 15 months. Obviously, I suppose first instinct is always super exciting and chuffed to see, female founders doing well, kind of attracting kind of investment. So awesome news on that front. Rachel, what's your take on this one?
I'm so glad you came to me first because I'm so stoked about this story, for so many different reasons. One, go through click into Belong, go sign up to their waitlist. It's such a slick experience using Typeform. It's exactly what you want to see out of a startup, but still making it feel like a wealth experience. So number one, really great MVP offering. Number two, more female founders doing exciting things because this is, the wealth space. We've always often talked about it needing disruption. We've talked about AI and what AI can do for the wealth space. But this is taking a slightly different approach because I think specifically right now, during a cost of living crisis, there is this feeling that savings just aren't enough. And people are trying to work out what to do. And I see in London on the tubes, you see a lot of ads for trading and investment platforms that are really it's hectic for consumers who don't quite understand the investing landscape. And what I love about their approach to this is that it's a little bit around education and simplifying it, lowering the barrier to access, but also lowering the barrier by using lending in a slightly different way. And I think that kind of borrowing to learn to save or to invest it's a really interesting concept that I haven't really seen in mainstream. So I think this is it's a really exciting tool. Obviously, I think I'm probably biased because I think it's targeting me. So I am fully bought in, but I think it's the kind of innovation I like to see in the fintech scene and the kind of positive signs I like to see out of VC and investment for sure.
Jason, what was your reaction to their raise?
So when I first read the sort of summary of the story, particularly the lending component, at first I was a little apprehensive in the sense that encouraging people to invest on leverage magnifies outcomes in both directions, right? Both positive outcomes, but also negative outcomes. However, I will say that when I went and looked through their site and read a little more, I was at least pleased to see that the way that they were positioning it is both diversified investment. So I don't think they use the terminology ETF, but buying the whole market as opposed to trying to pick an individual stock, as well as long term, which both of those things, as a proponent of financial education and responsible investing, make me happy. In comparison to other companies, Robinhood being the classic example, that have encouraged users to do the exact opposite, which is pick individual stocks, not just pick stocks, but use options, which frankly, I barely understand, let alone sort of your average consumer, and to actively trade those. And the reason why is because that drives revenue for Robinhood, given its business model of payment for order flow. So basically getting a small fee every time users trade stocks, trade options. So the leverage of the loan bit did give me a little indigestion at first, in the sense of okay, if you're borrowing £1,000 and heaven forbid buying some meme stock like AMC or GameStop, or I guess Donald Trump's Truth Social, you could make a lot of money if it goes up. You could also lose more than your initial investment if it goes down. So I was happy to see that they were, positioning this in what I would consider to be a generally responsible way of diversified investment, long-term strategy. And yes, using credit or using leverage to invest can increase your returns, but that does come with risk.
Yeah, no, I think that's a really, really important thing to call out. I suppose the thing that I'm really intrigued by is I think when we've looked at sort of the gender investment gap, and obviously there is a significant gender investment gap, one of the kind of traits that a lot of analysis shows of female investors is they are better at committing to longer term investments. They are kind of better at sort of holding investments over the longer term. And so I think, as you're saying, Jason, if you can get that money into the right kind of diversified funds that, encourage kind of that longer term strategy, then yeah, I'm really kind of intrigued to see how this plays out. And I suppose to your point, Rachel, about lending to where lending plays into offerings more broadly. Again, I've also not seen tons, but another fintech that I'm enjoying kind of watching how it plays out is a US fintech called LendTable, who are kind of, again, not the same space, but have, again, an interesting offering where they provide funds to employees so they can max out their 401k match or sort of pay basically their pension fund for people that aren't US based. So I do think there are some really interesting use cases for if you can use technology, better kind of credit decisioning models to help people to invest in their futures, because we just see in all the work we do that customers really, really struggle to prioritize the longer term when there's so much going on in the short term. People are already struggling to manage their credit cards, their mortgages, car repayments, money for their kids. People really just understandably struggle to set the money aside for that future that's 10 years away, 15 years away. So actually anything that can try and help the mass market customer to put money into those compounding products, I think is something that just needs to come into the space. At the moment, it is the privilege of the minority that have access to, in most cases, paid financial advice. So yeah, I really, really want it to do well. But yeah, Doug, sorry, I'm having a bit of a rant. So I'll
no, I completely agree with what you're saying, because you just have to look, at the micro lending scale and the success of buy now, pay later. And when you put it in the hands of people being able to kind of be lent this and understand, and hopefully, I think that's something we potentially talk about later on, but, by offering up these financial products, people are going to take them up. It's not that people have never wanted them. It's that maybe they haven't actually just been given access to them, like you were saying. And having that change and diversifying the amount of people that are able to invest it's going to create such a big knock-on effect, a ripple effect. And I'm really excited to see where it's going to go.
I'm the first person to poo-poo on buy now, pay later as well. I'm really not about lending, but what I love here is I think it's the combination of lending for not a short-term immediate benefit. It's not, borrow now so you can buy this thing. It's borrow now to invest in your future. And I think there's something really interesting about that dynamic. But also the education piece, all of us here have kind of alluded to that, the point around access and about really complex financial products and things that you don't understand. Even the example you just gave there, Kate, around pensions and 401ks and things that are actually really difficult for people who don't have, whether it's the education or the financial knowledge or the time to really think about these things and make a move towards it. And particularly for female investment, I see so many different startups Your Juno and Elvest and Female Invest recently, who are all over Instagram, and they're doing such amazing things with education, but it's all time related, and then it all requires you to be able to go into your investments or your money and make an action. What I love about what they've done so far is it feels like it combines that piece around education, or Belong specifically, I'm sure there are a few other startups that will do it as well, as combines that piece around education, simplifying, but also without steering too far into advice, sort of recommending a way to step into this in a safe and responsible way and build and invest in your future. And I think that I love to see that coming out in fintechs and startups, showing that you can still do something and create a viable business model, but also still educate. Because I think education never feels like a winning business model. It always feels like we should probably do some FAQs. It's never the thing.
Well, no, and I mean, I think, Rachel, I 100% agree with your point, distinguishing between debt for consumption. So I'm going to use BNPL to order this Domino's pizza, which I've literally seen advertised, versus I'm going to take on debt. Yes, I'm not joking. I think it was in the UK.
I'm worried.
I know. Versus I'm going to take on this debt to finance an asset, whether that's a house, with a mortgage, or investing it in stocks and equities, finance the purchase of an asset that is likely, statistically speaking, likely to increase in value over time, right? So if you're borrowing to finance consumption, that is functionally that becomes a tax or a drag on your disposable income over time because you have to pay, make that interest payment, versus taking on debt to finance the purchase of an asset that increases in value over time. And I mean, you guys are in the UK, I'm American, both tend to be very debt heavy societies, particularly when it comes to using credit cards, using BNPL to finance consumption. It not every country works that way. I learned moving to continental Europe where it's like, oh, like no one here has a credit card. People don't use debt to finance, going out to the pub or buying clothes at H&M or ASOS or wherever. And so yeah, I mean, I think there are places where debt can be welfare enhancing. And this, I think, has a potential to be a good example of that.
Yeah, fingers crossed. I suppose the usual disclaimer applies. Like, absolutely nothing in this show constitutes financial advice or guidance and all that usual stuff. But yeah, absolutely echo what Rachel was saying. I think from what I can see so far, it looks like they've had some really interesting ideas, and hopefully this funding gives them the space to really go and continue to test those and refine those with customers. So fingers crossed. Okay, on to our next story. This one comes from the FT Advisor, and that is FCA warns finfluencers to be on the right side of rules with social media ads. The Financial Conduct Authority, a UK financial services regulator, has published guidance clarifying what it expects from firms and influencers when it comes to financial promotions on social media. It said it expects adverts to be fair, clear, and not misleading, and must have a balanced view of the benefits and risks as well as be compliant. The FCA also said some promotions may require additional information, such as a prominent risk warning. They have also wanted companies who collaborate with influencers through affiliate marketing campaigns to take more proactive responsibility. Rachel, do you follow any influencers? Have you taken out any financial products on their guidance?
I'm just not an influencer person. I think that I really admire people who have built their businesses well as influencers, and I think that there are very responsible influencers in the space who only would try and test a product and then share it with their audience as if they would their friends, just like that extended. Exactly what I just did there. I love Belong. You guys should try it out because that's what I'm going to tell all my friends later. But I do think that there is this. I mean, it's like a broader piece about influencer culture. It's almost a little bit of a false economy. It's not really led by the products that influencers are using. I suppose it's more led by the companies that are sitting behind offering these lucrative partnerships to influencers. And so I think that, yes, obviously there's a very important piece of this for influencers and ensuring that they're partaking in the right deals. But I also think that there's a point around the companies that are partnering with them. If we think about, Martin Lewis, he's got years of experience when it comes to financial advice and hints and tips and guidance. And so I think he's very mindful when he steps into partnerships versus a newer influencer who's particularly not in the financial space being approached to be like, hey, we want to partner up with me and we can talk about finances to consumers. I don't think they have the due diligence. And so there's something around the partnership models that are emerging that make me a little bit nervous, because it suddenly feels like people who aren't experts are introducing weird and interesting concepts like investment to consumers who are like, oh my God, yeah, sure, of course I'll do it because my idol does it on Instagram. And I don't know if that's the right use of the platform.
Yeah, I mean, obviously, Jason, this isn't a UK specific issue, right? Like, everyone is having to think through this. What are we seeing happening elsewhere in the world?
Yeah, so I mean, you're exactly right that it's not a UK specific issue, nor is it inherently new, right? So I mean, the idea of affiliate marketing has long existed, including very recognizable names like Credit Karma, which exists in the UK, NerdWallet, LendingTree, these sort of comparison sites. And I think the challenge is the sort of, call it like Chinese wall between the editorial side and the business side, where, to what extent is a site like NerdWallet making recommendations based on what credit card issuer or what personal loan or what mortgage is giving them the highest commission? And that has been a problem. There have been cases in the US, it's the Federal Trade Commission, the FTC, that would do most of this stuff. But there have been cases around, the extent to which recommendations are influenced by the financial side of these businesses. I think with the sort of influencer culture the risks magnify because the level of sophistication or the controls, the compliance is potentially zero, right? I mean, if you're just like a TikToker or Instagrammer or whatever, you probably don't have a chief compliance officer who's familiar with the FCA regulation or the FTC rules around disclosures. And you're just, I mean, I actually saw a video on Instagram earlier this week about a new law called FCRA, the Fair Credit Reporting Act, which you could use to eliminate all negative data from your credit report. FCRA was passed 50 years ago, definitely not new, and it did not do what the influencer described that it does. So, I mean, you have a problem around whether or not the information they're giving is accurate, which in many cases it may not be. And then you also have a problem around, if they are receiving paid compensation, are they disclosing that? And are they disclosing it in a way that makes sense, right? Again, this isn't specific to financial services. Well, I guess crypto kind of is financial services, but you saw this huge wave of Kim Kardashian and other celebrities shilling the shadiest crypto products. And they're, the people who follow them went out and bought these coins, these tokens or whatever, and generally probably lost all their money. And in many cases, the celebrities didn't disclose that they stood to benefit from that.
But Jason, isn't that crazy that someone with a legal team the size of Kim Kardashian's would have fallen for that? And then we're now going to be applying those same rules to, as you mentioned, potentially a teenage TikTok user who is just being told by someone in finance, having a relative position of power just by that title, being like, oh, by the way, this is going to save a lot of your viewers a lot of money. And they go, oh, okay, perfect. That sounds great. And it'll be interesting to see. And unfortunately, I haven't seen the entire stipulation of what the FCA is putting down here, but where the liability will lie. I do believe actually, the prison sentence will actually lie on the influencer themselves, right? So, I mean, that
is a little crazy,
right?
Yeah, I mean, I would tend to say, and I come from a marketing background. I mean, mostly in the U.S. The responsibility should lie primarily with the company, right? So, if I'm running a campaign to promote a new credit card, and I want to go pay micro influencers to say, hey, I just got my Jason card. It's the best card ever. It's amazing. I get a zillion % cash back. If I'm the one compensating those influencers to promote the product, it should be on me to ensure that they're doing the proper compliance and disclosure, that it is a sponsored, compensated advert. The idea of sending somebody with 10,000 followers to prison seems a little excessive.
Well, the good news is we don't have to decide on this because we asked our listening community who they thought should be responsible for governing this. So only 18% thought it was the social media platforms, 51% said industry regulators, and 30% said financial services providers themselves. So interesting mix. Rachel, where do you sit?
Yeah, I just think it's a really hard thing to regulate, but considering how unregulated social media is, I think for the FCA to come down on this, I completely understand the position and the overarching mission to protect consumers. But I just think that social media and the communications landscape has shifted so much that if this is the thing to crack down on compared to everything else going out, it puts social media influencers in a really difficult position because they're business people. They're trying to do what all of the other people do to survive. And if you're a small, we keep saying the small teenage TikTok influencer looking at Kim Kardashian, if she's doing it, why would you not do it? Because she represents an amazing example of an influencer done right. So I just think that it's difficult to regulate in this. I think we talked about it a while ago, the pace of information, how quickly it moves now. I don't know how someone could keep on top of this, effectively. So, yeah, I definitely, it feels to me like whichever dodgy fintech / startup is pushing a weird non-compliant product on influencers, I feel like they definitely hold a lot of responsibility and they probably know what they're doing a little bit as well.
And I don't want to make this too dark and sad, but it's kind of sad that we've gotten to this point where people are getting their financial information on how to thrive from social media. I mean, I know you guys brought up Kate, you brought up Martin Lewis, and I know he's done a lot of work just trying to improve the general education of financial products and services rather than just finance. And I know that the school minister, I think the Guardian reported that Damien Hines, the school minister, said they would expand financial education in primary schools to teach younger children, and they're explicitly looking at maths, and that they would look at a further opportunity to help teachers get better resources for financial services topics as well. And that's a slight ad lib there, but I mean, it's fascinating to think that we have almost failed our children at this point in the fact that they are looking to TikTok.
Yeah, I'm going to go pick my son up from nursery and instantly sit him down and teach him the ways of money as a result of this conversation, for sure.
Yeah, but I mean, it's not purely a financial thing, right? I mean, it's true for all kinds of news and information, which let's just not go there.
We've definitely not got time. Okay, now for a quick look, just to round out the show, at some of the more click-worthy news from this week. So, Rachel, what have you got for us this week?
Yep. So this is from Finextra on a lighter note, or more interesting note at least. UK is set for soaring digital wallet adoption. So according to a new report from WorldPay, digital wallets set to comprise half of all e-commerce spend and nearly a third of point of sale transaction value by 2027. The likes of Apple Pay and Google Pay are fast becoming the go-to payment method for Brits. The COVID-19 pandemic accelerated this shift towards digital payment methods, and by 2027, it is estimated that digital wallet usage at point of sale will more than double from 14% to 29%. Meanwhile, cash made up 10% of point of sale transaction value in 2023 and is expected to drop to just 6% by 2027. We've obviously been talking a lot about payment and merchant fees, but I think it's a really interesting shift from when Apple Pay first came out, and it was a way to double click and pay for something in the store and all the regulation that's come out to support it. But also what's been interesting is looking at that shift when you're on e-commerce stores and online to see that you're actually able to integrate some of these payment methods into just how we save our cards, how we pay for online transactions. Also, what's interesting is the shift in how people are spending. So account to account payments has now dropped in the UK, and I think we're actually lagging in Europe compared to all of our credit and debit transactions. So I think it's a really interesting space, and I think it also creates a huge opportunity for fintechs and startups coming out to target more wallet-led solutions, and also an interesting problem for banks to try and solve in the future.
For sure. Our next story in this section comes from Access Wire, and that is HSBC Australia implements Proximity Vote Connect. Proximity, a leading digital investor communication platform, has partnered with HSBC in Australia. Their product, Vote Connect Total, is an innovative proxy voting solution, including features such as near real-time ballots, improved market deadlines, and instant delivery of votes. Additionally, Proximity's real-time digital vote confirmations tallies votes instantly. This empowers investors and shareholders to participate in AGM and EGM votes from anywhere in the world. HSBC expects to roll out Proximity across more of APAC if it proves successful in Australia. I'm guessing, obviously, if you are an issuer, an intermediary, or an investor, then you kind of might be interested in this just sort of in terms of this specific partnership. I tick none of those boxes. So I personally think it's kind of a cool one to watch in terms of internal bank innovation. So my understanding is that this started off as part of Citi's sort of D10X program. That's kind of an internal accelerator within Citi. It was then spun off, and HSBC Ventures is a strategic investor. So always kind of interesting to see when banks do invest in these kinds of platforms, if they then go on to actually use the products themselves. And they've, to their credit, they've got a pretty impressive list of financial institutions that they seem to be working with, from JP Morgan to Deutsche Bank and BNY Mellon. So yeah, I think it's really interesting. Sometimes we can be quite dismissive about bank innovation programs, but actually we're seeing some interesting propositions come out where actually some of these potentially more complex areas of financial services, some of these clunkier spaces, actually some of this in-house expertise is managing to find channels to create new things and launch new platforms, and hopefully that helps us to drive these spaces into a more digital space as well. So yeah, all the best to them in Australia. And it was so difficult for me not to try and do my atrocious Australian accent whilst reading that story, but I'm glad I succeeded. Okay, now it's time for the and finally section of the show, a look at something a tad more offbeat from the world of finance. We've taken our story this week from Yahoo Finance, and that is Real Housewife of Toronto star sells fintech to run a castle in southeast England. Anne Kaplan Mulholland is best known for being a reality TV star, but she is also a successful fintech entrepreneur. She launched Canadian company iFinance in 1996 and grew the business to a loan application pipeline of $2 billion. Go Anne. However, she sold the company last year and decided to buy the £11 million Limp Castle in the English county of Kent. She now runs the estate as a hospitality, events and wedding venue, which is kind of a bit of a fairly substantial pivot from Canadian lending. So, yeah, Rachel, is this convincing you to become a reality star so you can then go start a fintech and buy a castle? Is this your new future set out ahead of you?
Listen, if people were that interested in what I did, I am all about it, because this whole running a castle, hospitality events, that sounds super fun, really idyllic, less screen time, all about it. So yeah, if you're interested in me becoming a reality star, you kind of like my content, you just hit me up and we can get this going.
Jason, what was your verdict on Anne's story? Do you think we'll be seeing a Netflix drama sometime soon?
During the deep days of the pandemic, my better half and I somehow ended up on like a French castle renovation YouTube like algorithm hole, and started like Googling how much it costs to buy one. So like I'm sympathetic, and I don't know, with the amount of drama in my Twitter feed in the past week, maybe I can have a reality show.
Yeah. And I suppose, does £11 million based on your French castle experience, does that seem like a bargain? Has she got a bargain there, or is she overpaid?
That sounds pretty expensive. You can get some rundown castles in France or Italy for less than that. The problem is the maintenance costs and heating.
Doug, have you got your eyes on any castles at the moment?
I mean, it sounded like we were just describing Downton Abbey there, and at one point, is how do you keep them afloat? But she's obviously got experience in keeping things afloat with iFinance. So I wish her all the best, because I mean, sailing out into the sunset with a castle in Kent. I mean, is there anything better?
I think there's actually quite a good zoo that's near there as well. Like, I feel like I went there as a child.
If you take the train past it, you can see the lions, which in the Kent countryside is quite. Yeah, it's quite shocking to because no one believes you.
Yeah, no. One of our producers, Liam, is saying great zoo on the comments, so it's officially endorsed by the 11FS production team as well. So we're not recommending any financial products, but we are recommending a zoo. So go to the zoo. Jason, what would your dream job be? Obviously, Anna's found her dream here. What does the future look like for you?
If I ever retire from whatever it is my job is now, like I think I would want to run a dog rescue. I've become like a really intense dog person. My Instagram is like 50% dogs, 50% food. And whenever I see like the adverts trying to do fundraising for like, Ukrainian refugee dogs or some other neglected animals, I'm just like, oh. So yes, I would. I guess I would start a dog rescue.
Awesome. I think, obviously I really, really hope the newsletter works out and it's going really well. But I think that would be a great outcome. I'm sure you'd be brilliant at it. Doug, what about you? What's your dream job?
I think replace the castle in Kent with a little place in Italy next to the sea, and maybe have an Aperol or two as the sun sets.
Better food.
But that's
in Italy,
not really a job,
I was
is
going to
it?
say, where is the work in that?
Yeah, I mean,
The job is retirement.
and like a professional Airbnb host, I guess, but just in the But maybe Rachel, I think you're right there. The job is retirement.
That would be the dream, wouldn't it?
Rachel, is your job also retirement, or have you got something slightly more active in mind?
Well, I will say, in one of my summers at university, I worked at a youth hostel, big up Boggle Hole up in North Yorkshire. And it was just like, it was the dream job. Like, it was like a small team and like right on the coast. And, after work, like we went kayaking, went to go see the seals, and there was like a fire pit. It was just, I actually really liked that. So maybe my dream job is just going back to my roots and back to the Youth Hostel Association. What about you, Kate? What's your dream job?
I really
Apart from customer
Obviously,
strategy.
that is the dream. I mean, I suppose anything really where I get to just people watch. I just love people watching. So actually, I feel like my ideal job would be something on the London Underground, which is just the most interesting collection of people and strains of humanity, like on the planet. You just see so many amazing, wonderful things. And I particularly like, I don't know, for our listeners that have used the London Underground network, there's this like a special moment when people are running to get to the train and they jump through the doors and they just make it just as the doors close. And it's kind of like the end of a really intense action sequence in a film. So I would quite like to be an announcer on the platform just so I could witness those moments time and time again.
You've thought this out?
Yeah, I have actually. Yeah, every time I'm on the tube, I think, this is where I belong. This is where I should be. I just really, really love it. So but I'm an odd person, and I think that's come out on the podcast many times already. So I don't think that's new. Okay, on that very bizarre note, that wraps up this week's FinTech Insider News. Thank you so much to today's guest. Where can people find out a bit more about you, Rachel?
Obviously here at 11FS or on LinkedIn, I'm Rachel Pandian.
Awesome. Jason?
They can subscribe to the newsletter at fintechbusinessweekly.com. For some reason, I'm still on Twitter at McCullough or on LinkedIn.
With drama by the sounds of it. So yeah, go check it out. Yeah. And Doug, what about you?
Until I get to that place in Italy, I'm glued to LinkedIn. So do catch me at Douglas McKenzie over at LinkedIn.
Awesome. And as for me, you can find me wandering around the London Underground and also on LinkedIn, Kate Moody or kate@allenfirst.com. So thank you so much for listening. You can join the conversation on social media or email podcast@allenfirst.com. Thanks very much. Goodbye.